All right, guys. So thank you guys for joining me for today's lesson. We're just going to go over average to range and risk management. Average to range is a fairly new indicator that I just started using, particularly for my day trading, as it kind of helps determine when there's volatility in the option price and stock price. That gives us good entries, and it can also help you determine the scale of the moves that you're expecting. Right? Typically, when you see ATR is high, that means there's a lot of volatility in the stock price, so that can lead you to have certain ways to position into it and have certain expectations on the extent of your moves that will take place. So I'll describe that in a bit more, but we'll be talking about ATR here, a fairly new indicator that I added to the charts. And we'll go into a little bit more detail. I'll talk about the settings that I use for the ATR, and we'll go into a little bit. I mainly use it for day trading, but I'll talk a bit about how it can also be used for swing trading to determine like volatility in specific stocks, as well as how it can be used to adjust your stop loss and your take profits. And then after ATR, I'll talk a little bit about risk management, as I think this is key. Risk management, as you guys know, is one of the main pillars of being a successful trader. And the reason why I wanted to do this course is because I feel like there's a lot of members that are in the group that jump into a lot of trades with the expectation of profits first, right? They don't really think so much of having a kind of built framework around their trade, and that is very important, right? You need to know when you jump into a stock what the risk is that you're taking, what is that ticket price that you're paying in for those expectations for those profits, right? Because I'm pretty sure all you guys know that trading is risky business, right? There's no guarantee of profits here in this game. A stock can go south real quickly or it can really make you profits. But if you go in with a risk first mindset and you have a good psychology around it, then your odds of being successful are greater, right? Rather than someone that goes in with the expectation of profits, the stock turns against them, and that leaves them in a panic, unsure what to do next, what the next kind of step is. And then for that reason, they kind of message in the group in a panic, Harvey, or they message my dad, or they message other members asking, what should we do with this name? So that's not the goal of our group, right? Quick disclaimer here before we get started is that everything in this kind of presentation is meant for educational purposes only, and that trading does inherently come with risk, right? Nothing is ever guaranteed in this game. You do have the risk of losing pretty much everything that you invested in, depending on the assets you play. And if you short assets or you short stocks, you have the risk of magnifying those losses even further. So it's very important to have that risk management mind. It's also very important to think on the risk first place, because again, the profits are not guaranteed. So we're going to go over some examples. We're going to talk about some situations as well. Just note that again, guys, everything in this presentation is for educational purposes only. Please don't consider this financial advice. Again, this group is meant to really teach you guys on how to become successful traders, right? That's why I don't want this to become like an alert service where you kind of see a stock that I put out in the research channel, or I put in the portfolio alerts, and you just follow it blindly, right? The goal is to make the trade your own and to pretty much use us as a source of like information and for education to become better traders yourself, okay? So just a quick disclaimer there, I want to go over that. So again, we're just going to go over ATR here in the beginning, as this is a fairly new indicator. So I just want to describe a little bit about it, as if you guys do attend the live sessions that we do every day, you will see that I have ATR now on my main screen on those charts, right? And it is a very helpful tool for day trading. Especially as it really helps you determine the scale and the kind of length of certain moves that you could explain for. As again, most of you guys know, for day trading, we're scalpers, right? We're kind of jumping in to like ES and NASDAQ, trying to get our 10, 15 points quickly and then call it a day, right? We're not really looking to hold the stock for a long time. So ATR can really help with that, as it can help determine times where there might be a more suitable environment for trading and times where you might want to step back and maybe not trade as much, right? And it can also really help you determine your position size and going into a lot of trades as well. You will see like a lot of traders, like a lot of people that do classes, a lot of traders that speak online, they tell you guys to stick to like one certain risk size, right? Even like I used to do that as well. When I first started trading, I used to have a set, like only trade 3 contracts and that's it, never go higher, never go lower. But once I found out about ATR, I kind of changed that mindset, and I'll teach you guys as well on how I kind of use ATR to determine position sizes in order to kind of capitalize on quick moves in these stock prices. So I mainly trade the NASDAQ, so we'll go off of that. But you can also use this for like the ES, you can use it for crude oil, you can use it for gold. You even can use ATR for your stocks and your swing trading, and I'll talk about that in a minute here as well. So to kick things off, pretty much what is ATR, right? What indicator, what does it show? Well, the quick definition definition of ATR is that it's a measure of volatility by showing the average range of an asset's price movement over a specific period, right? So it goes back on a certain look back period. So as you guys know, we use the candlestick charts. So it'll go back like 14 or 21 candlesticks. The default setting is 14. I also use a look back period of 9 for day trading, just to kind of adapt to quick movements that are happening in the futures price, right? So it pretty much looks back in those candlesticks. So go back 14 candlesticks, 9 candlesticks, whatever setting that you use, and it'll take the high and the low price from each of those candlesticks and determine an average range, right? And from that average range, you can then determine, okay, whether the asset that you're looking for, is it volatile or is it not, right? Because if you have a high ATR, right, then you're going to have much more range in the prices in the previous candlesticks. So you're expecting a higher level of volatility and wider price range action to take place in the asset that you're trading. If you have a low ATR, that means there's a low range in the difference between the highs and lows of the candlesticks. Then that indicates a low level of volatility and very tight or contracted price action, right? So you're not looking for, big moves. You're not looking for, strong follow through, but rather quick in and out type of plays, right? ATR itself does not determine direction, right? So sometimes you'll see kind of ATR rising or ATR dropping off. That doesn't mean like the stock price is rising or the asset that you're watching is rising or falling. It just means that the range in price is either expanding or contracting, right? If you start to see say like price action has been very contracted, like there was a series of lower highs and higher lows, and price action is getting very tight, then you'll start to see ATR kind of slowly drop off, right? It'll start to go from a higher level trickle down to a lower level, right? But if you start to see kind of price then contracting, and then as you see volume start to come in, range starts to expand, then that's where you could look for potential breakouts as it shows expansion in that price range. So ATR is very helpful, not determining direction, but determining the scope of moves, as well as if we're dealing with, a choppy sideways type of market, or if we're dealing with a lot of volatile price action, right? So I mentioned earlier that ATR can be used for day trading and it can be used for swing trading, right? For swing trading, how you can use it is you can look at relative ATR, right? So never compare like the ATR of two different companies and be like, oh, this company has a high ATR, so it must be more volatile. This company has a low ATR, so it must be less volatile. As each ATR is different for the company, right? You'll see that typically the stock prices that are high, like say 600 or 300, stuff like that, they tend to move up and down in much larger price ranges than a stock that's say priced at $10 or $20, right? So you don't have to really look at it at a stock to stock basis, but look at relative ATR, right? If you start looking at a stock and you're seeing that ATR is below what it used to be, kind of looking at a low average, then that can tell you that that stock is undergoing a period of contraction, right? And if you start to see that ATR start to expand, then you're possibly looking for breakouts, you're looking for that expansion, you're looking for possibly, a wider, stage 2 kind of type of uptrend, right? So look at relative ATR, don't compare it between two companies, and also look to see moments of contraction versus expansion, right? Sometimes you can use it as kind of higher ATR stocks. If you're seeing that, the relative ATR is much higher than what is normal for the stock, then that stock could be undergoing a period of high level volatility. So let's say, for example, they have some sort of news release, they undergo some sort of new product. Well, then in that case, that stock may be more suitable for a day trade or a swing trade type of stock, right? And if you're seeing that the stock is experiencing relatively low ATRs, right, meaning that it could be contracting or it could be not seeing not much range in the price action, then that type of stock might be more suitable for longer term investing. All right. So hopefully this gave you guys a clear picture of what exactly ATR is. It's just pretty much average to range. It takes look back period, determines the highs and the lows of a certain period that you use. Typically 14. I like to use 9 for day trading. It looks at those 9 candlesticks, takes the highs and lows, averages out, and determines a range that you can then base your information off of, right? The scope of moves that you're looking for, as well as it can help you determine volatility, right? So what are some of the practical ways that I use ATR? So the first way that I use it for day trading is to determine my position size, right? So I have ATR on my charts. I'll show you guys real quick here how I have it set up. Again, if you guys do tend to the morning live sessions, right, we do for you guys, you'll see that this is the main screen that I share now. And you can see that ATR is this red line that I have at the bottom, right? So this ATR indicator, if you click on it, is just a basic one that's provided by TradingView here. If you just type in ATR in the indicators tab, it's the first one that comes up. And I'll quickly show you guys my settings that I have for it. So I use it on the 2-minute time frame. I set the length to 9. I use the RMA for the smoothing, and then I put on the 2-minute time frame, right? So I leave the RMA to default, and I just change this from 14 to 9, and I change the time frame for 2 minutes, all right? And these are settings that I use for my day trading when I trade ES futures as well as the NASDAQ futures, okay? So pretty much what I'm looking for at the ATR levels that I'm coinciding with is if you see an ATR on the S&P 500 around 1 or 2 or the Nasdaq around 3 or 6, then that is a very low range, right? You're not really seeing much volatility in price action. You're seeing a lot of contraction. You're seeing the scale is very sharp. Like you can see ES probably trapped in like a 10-point range on the 5 minute. Nasdaq is probably trapped in like a 20-30 point range. You're not seeing much movement. Well, in that case, if there's a low ATR and we're not getting much volatility, then I'll up my position size, right? Because we're scalpers, right? We're trying to get in and out pretty quickly. We're looking to get our gains in. So if I put in more contract size, that means I'm getting more, dollar value for that tick change, right? Typically, if you trade one contract on the Nasdaq, that is $5 per tick, is $20 per point. So I'm looking to kind of maximize to scalp, quickly get in and out. If ATR is low and we're not getting much volatility, well then I will trade a higher position size and I will keep my stops much tighter, right? Closer to my entry or closer within the range of whatever, is happening in that price build, right? Typically, I like to use a 15-point stop loss on the Nasdaq contracts, but maybe if it's a low ATR, maybe I'll switch it to like a 5 or a 10-point stop loss, right? A medium ATR is typically what you normally see, and it can indicate regular price action. A good scale here for ES, a good ATR would be around 3 to 5. For the Nasdaq, it'll be 7 to 12. And then if that's the case, then I'll use my normal position size, which is around 3 to 4 contracts, right? Typically, I trade on the Nasdaq, I trade 3 contracts, and then I'll put a stop loss of 15 points here on the NQ when ATR is at decent levels. And when ATR is at these levels, it's pretty much normal price action. You'll see a lot of range. You could see a lot of up-down movement. Price could actually also be possibly trending in an upwards or downwards action. It indicates that there's good volume in the market. It indicates that there's good volatility in the market, right? And then if you have a high ATR on the ES, it would be around 6 to 10. And for NASDAQ, it would be around 13 to 20. And these are typically moments when you have like news-based reactions, right? For example, during FOMC, we were seeing a pretty high ATR. Sometimes it came above these levels. At one point, NASDAQ was above 20 on the ATR, right? So you kind of typically see these levels during news events or around the open, right? At 9:30, when you start to see prices, first start to fluctuate up and down, there's a high amount of volume that comes in at the open due to those market open orders, and that could also lead to a high range in price action as well. So during times of high ATR, then I like to size down my position because each candlestick could give you more moves, right? One candlestick could quickly jump 20 points, quickly jump 25 points, giving you your target profit that you need for the daily payout, right? So typically when the ATR is high, I use a 1 to 2 position size, and I'll keep my stops much wider because then that avoids me getting wicked out, right? If ATR is high and the range in each of the candlesticks is high, then it does lead to a lot of wicky type of action. And if you don't measure, what the volatility in that price action is, and you keep your stops too tight in a high volatile environment, then chances are you could get stopped out a lot quicker. So for that reason, when ATR is high, I use a low position size and I keep my stops very wide. When it's medium, it's just trading as normal. And when it's low, then I like to keep a higher size, but then I keep my stop losses much tighter, right? And this, again, isn't like the standard norm, right? This is just what I found comfortable for myself. Make sure you guys, when you guys do trade, you find a position side that is important for you, right? The second kind of pillar of being a successful trader is you need to have good trading psychology, right? And main thing that goes into psychology is position size, right? So if you find yourself off the bag, like say you trade 3 to 4 contracts on the NQ, but you get really jittery, like you're kind of hesitant on the moves, you're kind of getting panicked when you're seeing big upskills in price action, then that could lead you to make very common mistakes, right? I remember when I first started trading, how I got into trading is I saw someone post on Twitter that they were making like $10,000 a day. But what I didn't know is that they were trading a lot of contracts to get that. They were trading like 10, 15 contracts at one time, getting 10, 15 points a day, and then they were calling it a session, right? But I didn't know that. I thought like, okay, I could jump in as well, and I can also play that high size, right? And then when I first did, I blew a lot of counts trying to play that max size. I would go like 10 contracts deep on some trades. I'll go 15 contracts deep, but one tick or one slight movement would freak me out because there'd be so much money that changes in that one moment, right? And that wasn't really good for my psychology. So I sized way down. I went all the way down to trading one MES contract. Once I got comfortable with that one MES, then I sized up to one full ES contract. Once I got comfortable with that, then I sized up to started trading MNQ contracts. I went from like 3 MNQ to 5 MNQ, and then from there now I trade the full NQ size, right? Because now I'm used to it. Now I feel like I'm a better trader. I'm more experienced. My psychology is better and it's what I'm used to. So everyone goes through their own journey. Don't take this as kind of standard template, but I want you guys to note that if ATR is low, typically you want to use a higher size and you want to keep your stops tight. And if ATR is high, then you want to keep a lower size and keep your stop losses a bit loose, a bit wide. Okay. So hopefully that was clear with everyone. And again, just a quick lesson on ATR, as it is a fairly new indicator. Again, I only started applying it to the charts about like 2 weeks ago, and I'm still kind of learning how to use it as well. But I back tested it, and I found it's very cool. It works a lot well with our trading, right? With our trading, we can determine direction by looking at the price action, by looking at multiple time frames. We can determine momentum by looking at the TTM and by looking at the volatility indicator, and we can determine the internal strength by looking at the market internals, as well as looking at the big seven, Meg 7 tech names. But using ATR with all this stuff, it could really help you determine the scale of your sizes, right? If ATR is high, then I can look to see, okay, price action is changing very quickly. I can hop in with a lower size, get my daily payout, and then go do something else, right? Don't have to kind of dive into taking too many trades or over trading, stuff like that. So ATR is really helpful in that sense, and I mainly use it again for my day trading on a daily basis now. All right, so that being said, let's jump into the next thing I want to talk about. Again, not a long lesson here, but just planning to go over some of the key topics as risk management, right? So risk management is very key, because I really want to do this lesson as well, just because I know a lot of traders that are in the group that see, like, when we're sharing names, that they jump in with the expectation of profits right away, right? They're not approaching the trade on a risk first basis, because they believe that, okay, Harvey did his research, my dad did his research, it must be a good stock, right? But that's not always the case, right? And even whenever I approach a trade, I approach it risk first. I don't have the expectation of profits. I see that, okay, does this meet my risk criteria? Does it meet my psychology? And then I would jump in, right? It could have the best fundamentals, it could have the best looking chart, but if it's not giving me that risk that I like to see, or is not giving me something that I'm comfortable with, then I won't take the trade, right? So that's what kind of mindset I want you guys to start thinking in, is that when you see a trade or when you see a post, do your own due diligence, right? See if there's something that works well with you, and then approach it from a risk first, right? Think of like risk management, think of stop loss as like your ticket price, right? What is your lotto price? What is that price that you're willing to pay in order for that expectation of profits? All right. So the first key risk management tool that I use is the stop loss, right? And risk to reward, right? And typically, the stop loss that I have, the max loss or the max risk that I will take on a stock is 7 to 8%, right? So no matter what, wherever the stock is at, I'll put my max stop at 8%. I like to use the key moving averages, like you'll see on the charts. I like to use the 10-day EMA as the 21-day EMA, and sometimes the recent swing low are areas where I'll adjust my stop, and I look to see if it's in that 7 to 8% range, right? If it is, then it looks good, I'll take the trade. If the recent swing low or if the 10-day, 21-day EMA is a bit extended, then I still won't take it. I'll have to wait for a better setup. I'll have to wait till my risk reward characteristics make sense, right? And then once I place that initial stop, it's not a hard stop, right? I adjust it accordingly, right? If the stock starts to move quickly, like say you see you put that stop in, and then the stock does a quick 10% jump to the upside, or 10 to 15% move to the upside, well, then I'll quickly adjust my stop to break even, because that's a pretty parabolic move, right? I don't want to give up those gains, and I'll pretty much make the trade risk free, right? Sometimes also, you guys will see that in the portfolio alerts channel, when I establish those buy zones, sometimes you see the 10-day EMA kind of creeping up into that zone as well. And if that's the case, then I'll just put my stop loss underneath the 10-day EMA, and I'll pretty much ride the stock on the way up, right? Pretty much keeping my stop pretty much risk-free, riding that 10-day EMA and see how far the stock wants to go. So it's not a hard stop, but initially I will put that 7 to 8%. It has to be a matching with the key level, looking at the 10-day, 21-day, or a recent swing low. And then once that stock moves, then I'll adjust it quickly to break even. If it gives me that 20%, 15% return, then I'll slowly start to adjust it into profits, right? Typically, I work with a 2-to-1 or a 3-to-1 risk reward ratio. So typically, if I'm risking like 7 to 8%, I'll look for about a 20-25% return, and then I'll adjust my stops accordingly, right? And I'll show you guys a bit. I also have an Excel file, which I'll share with you guys, which also does a lot of calculations sense for you also, right? If a stock is in a turnaround situation, like for example, let's say it's been downtrending for some time, the stock has been beaten up, say there was negative news or something, and it's causing a push lower, but now it's giving us signs of a turnaround, like it has a good base setup, it got above the key moving averages, and it's giving us a higher low. Then I'll look at previous price action to the left and determine areas of point of interest, right? Typically, I'm looking for previous swing highs that I could mark as potential take profit areas, or I'm looking for gap down levels where the price could look for a potential target to then be filled, right? So if there's no previous price action, then I'll go with that 20%, 25% return. I'll put that as my take profit. But if there is past price action, again, looking for prior swing highs, swing lows, and looking at for prior gap down levels that I could then use as potential target areas as well, right? So the key thing here, guys, is always approach a trade risk first. Ask yourself, is it worth the risk? Don't just get glamored with the expectations or for quick profits, right? A lot of people think they'll jump into a stock, they'll not consider the risk, and they're like, okay, I just want my $100, I want my $200 going into it. But that's not the right way to think, right? If you start thinking that way, you might get lucky a couple times, but most often than not, the stock that goes against you, people start to panic, and then those rise of emotions start to take over, right? Because you didn't approach the trade with any sort of framework, right? So if the trade starts to go against you, right? Say you have that expectation of profits, you're like, oh, I'm just gonna go quickly in. Stock already ran up so much, it's gotta squeeze out another 100, 200. But then it starts going against you. If someone that's riled up on emotions, they end up holding that stock forever, right? They don't have that kind of exit strategy, and it could keep going down, keep going down. Then this nasty thing called hope starts to come in, right? People start to like hope. They start to use like other means to kind of pray that the stock goes up, right? Every sort of tick that goes in the upwards direction becomes like a godsend, but every tick that goes against you, becomes like, why is the market playing against me? And you start to rely on emotions more. But if you start to apply it with a framework basis first, if you already have your exit strategy in mind before even entering, then emotions kind of start to take a back seat, right? The trade becomes a lot more robotic, it becomes a lot more rules based, and you kind of take that panic and that emotions out of it. So stop loss is key. Again, practice your accordingly, but you can use the 7 to 8% isn't a rule that I use. It's part of the Canston strategy, it's part of the Mark Minervini strategy, so it's one that I found helpful as well, because it really does help keep your losses small, and it helps keep magnifying your wins greatly, right? Because not every stock is a winner, right? We've been showcasing a lot of winners in this group lately, but that's not always the case, right? Sometimes you can share a stock and it could be an absolute dud, it could go against us, right? Or it could just be unfortunate, unlucky, get hit with some negative news in that time, and it could go against you. But if you have more winners than losers, if you have a high risk to reward ratio, then you could still be profitable, right? If you stick to like a 2-to-1 ratio, if you have an 8% stop, you can have a 40% batting average, like a 40% win rate, and you would still be profitable in the long run, right? So that's kind of the mindset that I want you guys to have when approaching these trades, because not every trade can be a winner. This game is very risky, but if you have good psychology, if you have this good risk management rules in place, then your odds of success are much higher, okay? And the second risk management tool that I want to discuss today is position sizing, right? So with position sizing, it's also very important because it can also keep a lot of the, risk out of it, right? Psychology is very important. So you want to trade with a position size that you have a good risk ability as well as your characteristics, right? If you're comfortable taking a lot of risk, if you're not, again, we'll see what it plays. With day trading, I mentioned already kind of how I determine my risk size. It's pretty much with ATR. If there's a high ATR, there's a high average range, then I will lower my size. I'll keep my stops wide. If there is a low ATR, then I'll up my position size and I'll keep my stops narrow. But for swing trading, again, I don't use this strategy, but I found it very popular. I was doing my research on ATR here over the weekend, and I found that a lot of traders assign a multiple to ATR. So they'll take the average to range of a stock in the last 14 or 21 days, and then they'll add a certain multiplier that they're comfortable with, and then they'll put that stop loss below whatever the current price is. So for example, ATR for like Tesla has been like 30 or 25 in the past couple of sessions, then they'll put like 25 plus like 6 points or whatever their rule base tells them, and then that's what they'll put their stop loss as. And I find that as a good strategy because it can really help you stop getting wicked out, right? If you know what the range in price action is expected to be on a daily basis or whatever time frame that you use, then it really helps you determine what the extent or the scope of some of these moves could be, right? So it really helps determine your stop loss, and for that reason, it could also really help determine where you should potentially take profits, as you're looking for the average range that the price could move in, right? So again, that's not what I use. I'll go over in a bit pretty much how I determine my position sizing. It is purely on a risk basis, right? So I take the risk on total equity, I take how much I'm risking in terms of my total portfolio, and I take my stop loss, and then from that I determine pretty much how I'm going to size into the position as well, right? Volatility is also very key. Sometimes you find stocks that are a little bit more volatile in nature, that have a bit more, higher ATR, move up and down a little bit more, kind of like your tech-based names also kind of have a high ATR versus like things like your financials or your industrials, right? So volatility is also very important when determining your position size. And also a key rule of thumb is, never average down, right? If you have a stock that is losing, it is very tempting to, average down to lower what your average cost is in order to catch a turnaround. But why would you want to average down in a stock that is losing, all right? If a stock is going down, it's going down for a reason. So you should never really pair average into it, because it could just magnify your losses if that stock continues to tumble, right? So rule of thumb is I never average down. I have my stop loss in place. That's solely what I look at, and if it hits, it hits. But I would also pyramid in, right? Typically, you guys also know, if you guys attending kind of the morning session, which I'm pretty sure most guys that are in the Discord right now have been, you will know that in the morning sessions that sometimes when the market is generally a bit risky, you'll see that I'll start off with a lower size. Like I'll start off with like a 25% my max size, or 50% my max size. And then if the stock is moving well, or if the market is kind of moving in the upwards direction, then I'll up my size as we go, right? So I'll start to pyramid into the stock versus averaging down, okay? And that's very key. So that is pretty much how I determine kind of those two main tools, right? If you focus on your position sizing, if you focus on your stop loss, you from there already will be much more successful than a lot of traders, because a lot of traders, come into the game with these expectation of profits, with these expectation of quick gains. And I get it. The stock market is very enticing, right? You see it kind of every day. If you look at the FinTwit, you look at the stock market, continuously making all-time highs. Crazy stocks like Oklo have been giving some magnifying returns in the past couple sessions. So it is very easy to get enticed with a lot of these moves. But again, you want to kind of keep yourself grounded. You want to keep these things in mind and approach trading on a rules-based approach in order to be more successful in the longer term, right? So I'll share with you guys pretty much. I'll post this Excel file in the group as well, but this is pretty much how I determine my position size, right? So it's all based off this formula. So pretty much in the top left, I put my total capital. So for example, I put 50,000 here, and then I'll take my risk percentage on per trade, right? This is risk of total equity. So general rule of thumb from Mark Minervini as well as from Canslim, they use a 1% to a 2.5% range. If you're more confident in a stock, let's say all the check marks are being hit, it is giving you that confidence, it has strong fundamentals, right? If you want a refresher of what we look for swing trades, you can check out the in the Getting Started channel, the swing trading, day trading refresher. You can also check out in the past Sunday live sessions where I talk about this as well. But if I'm more confident in a stock because it is meeting all our check marks, it's giving us good, good fundamentals, good technical setup, it's a reasonable, stop loss, then I'll risk a little bit more, and then I'll risk 2.5%. If it's a bit high risk growth, not really showing fundamentals, but it has a really good setup, a really good story, then I'll risk a little bit less. I'll kind of move that down to the 1%, right? So right now I have it set at 2.5%. And then after that, I'll set my entry price, right? So whatever I'm buying the stock at, wherever that buy zone is, that's kind of where I'll put as my entry price. Stop loss here I have set as 7% of what the entry price is. You can adjust this as well. Again, 7%, 8%. If it's even less, the better. Like if the 21 day is kind of floating at a 5% stop loss, that would be even a better move. You can put 5% there. But whatever your stop loss is, you can put it at that percent. But I kind of have a standard set at that 7%. And then I have a standard take profit at 20%. But you can also adjust that as well, depending on what the chart is telling you, depending on what your expectation for profits are. If it's a really good setup and it's giving you that move, then you can put a higher take profit there as well. And then after that, it'll determine pretty much what your risk should be, right? It'll take the dollar risk per trade by multiplying the total capital by the risk of total equity. It'll determine the risk per share. It'll determine the risk per share by taking the entry price minus the stop loss price, and then it'll divide these two numbers to determine your position size in number of shares, right? So taking your dollar risk per trade dividing it by your stop loss, and it'll tell you that, okay, if you're buying this company at $17, you want to risk 2.5% of your equity at a 7% stop loss, then you should buy 1,050 shares, and then your position size would be 17,857 of your capital, right? Capital remaining would just be these two minus each other, and that's how much you have left. But 17,857 would be your position size, right? And that would be 1,050 shares. So that's just determining, pretty much looking at the risk on total equity and your stop loss, right? And then from this, you can pyramid in, like say you want to do 25% initial position, then 50%, and then you can go full size depending on your risk tolerance, right? But then off this, you can get your calculations, you get your expected profits by taking the by taking the take profit minus the entry price times by your position size, and you get your expected profits that you expect to make from the trade. Your stop loss would be your dollar risk per trade, and your risk reward would be calculated there, dividing those two numbers. So pretty much this is how I determine position size for all my stocks, right? I'll show you guys with the pivot area. Once it's entering that pivot, I'll quickly go into my Excel file here. I'll put in the entry price, I'll put in the stop loss, I'll put in the take profit, and then from that it'll determine what my position size would be and how much capital I'll have remaining. And that's pretty much it, right? Purely rules based, right? Nothing going by speculation, nothing going with personal judgment. It's all based off of risk and approaching trade on a risk first basis. All right, and I'll share this with you guys. I will put it in the education channel along with the recording here as well. All right. And that's pretty much it, guys. That's all I really wanted to go over in this lesson. Just a quick short lesson here with you guys. Just going over pretty much ATR, as it is a relatively new indicator that we set, and as well as I also share the settings that I use in the education channel with you as well. And I also want to just go over a little bit about position sizing, right? Because again, I see a lot of traders. We're getting some good stocks here, and I hope everyone is banking, but I want you guys to, make the trade your own. I don't want you guys to just blindly follow us because what we're saying, and then, you guys thinking that, like, we're good traders. Like, I won't do my own horn. My dad's a very good trader. I'm a good trader. We have a lot of really good traders in the group here as well. So I don't want you guys to be going solely, okay, because he's sharing this stock, it has to go up, right? It doesn't have to. Everything carries with risk. It could go against you very quickly as well. So if you approach on a risk first basis, if you do your own research and you have that due diligence and you have that insight, then it makes yourself a lot more confident in the trade as well. So the goal is to, again, take what we're giving you guys and make the trade your own. And hopefully this presentation can give you guys one step closer on that goal to be a bit more successful. All right. So